I'm Alison Warner, founder of Evolve and Grow and author of Build and Grow. Welcome to the Evolve and Grow podcast show, where I share lots of useful tips and advice to tradespeople who are looking to move off the tools and grow a really successful business. The build system, business planning. In this podcast show, I'm going to share with you some tips and strategies to try and demist some of the confusion that often surrounds the numbers. It's so important that you have a strong handle on the figures in your business. It's difficult to make any meaningful decisions that involve additional costs without seeing exactly where you are. Getting up-to-date, meaningful financial information on a business in this industry is itself often a challenge, but I'm afraid you need to do it, even if it is your most recent year-end accounts. So let's start with cost of sales. Put simply, these are the costs incurred if you make a sale. For example, materials, subcontractor, labour. You will only spend something on these areas if you're actually making a sale. Gross profit. Our sales minus the costs of sales leaves us with gross profit. The percentage of sales that this is can vary from one trade to another and will depend on whether you employ your staff or you contract out. Overheads, also referred to as semi-variable costs. These are the costs that you have in running the business regardless of whether or not you make a sale. For example, rent, salaries, insurance, etc. Some of these will remain static, for example, rent. Others may increase as sales increase. For example, you may need to employ more people, hence salaries would increase. Operating profit. This is also referred to as net profit before income tax, or earnings before income tax, depreciation and amortization, EBITDA. This is the amount of profit you have made on which you need to pay corporation tax, which at the moment is 19%. This is obviously if you're a limited company. This is another reason why it is so important to know your numbers so that you can ensure you're putting sufficient aside for tax. And good practice is to put 19% of the operating profit into a separate tax account. Generally in this industry, there is no shortage of demand for one service if you're good, i.e. most business owners know that if they had more people or were better organised and took every call and followed up on every quote, they would easily increase their sales. In order to make the numbers meaningful, we need to do something called common sizing. This is where we represent the costs as a percentage of sales. And the reason why we do this is that as sales increase, the percentage of these costs will remain the same or are likely to. So for example, if materials are 30% of sales, this is likely to remain the same regardless of the volume of sales. This is also likely to be true with the percentage of subcontractor labour. However, overheads won't remain the same percentage of sales as the volume increases. A cost such as telephone or broadband is a constant, unless, of course, you start to install additional phone lines. You may, though, choose to acquire an additional van or take someone else onto the payroll, which would, of course, increase the cost of these lines. So take a moment and make a note of what extra resources you would need. In this industry, generally speaking, your materials should be around 35 to 40% of sales. They may be lower, they may be slightly higher, but that gives a general indication. Depending on, obviously, on what trade you're in, it could be different. Pricing a job. In my experience, this is a common area where business owners become unstuck. Often quotes are done on the back of a fag packet, i.e. quickly scribbled down, calculating the cost of materials, labour, and then an amount added on for profit. The problem is that this is often not accurate, and because of a fear of not winning the work, the business owner tries to quote as cheap a price as possible. To top it all, they often don't have the correct systems in place to show afterwards if any profit has been made on the job, and therefore the cycle continues. It's a good idea to get a CRM system in place, and there's various good ones on the market, We often recommend ServiceMate for businesses of a smaller turnover and a system called Simpro, that's SIMPRO, that is good for trade businesses with probably around 5 to 6 engineers out on the road. And these systems can really help with the quoting process and then comparing the forecast to the actual afterwards to show, was your estimate accurate and did you actually make profit on the job? As I say, it's so important that you understand your numbers. Often I find that a tradesperson's strength lies with people, i.e. seeing potential clients and winning business. In many cases, it isn't in the back of house activity, such as tracking and analysing the financial performance of the business. And even when it is, the owner usually hasn't been developed to make the most of those strengths. This was the case with Lee, the owner of a garage who was referred to me by a mutual colleague. When Lee arrived for his consultation, I could immediately tell that he was bright. However, he was extremely stressed with his business and had a belief that it couldn't be done any other way. He had almost resigned himself to the fact that it was impossible to make money in an ethical way in the garage industry. What also struck me was his strong commitment to the customer, his values around charging a fair price. He honestly thought it was impossible to charge a price that was fair to the customer and produce sufficient profit for the business. We began working together the following month, and the first thing we did, like I do with all clients, was to get him under the skin of the numbers. I profiled him, which I'll come on to in another podcast, and discovered that he had a natural propensity for numbers. He just needed some training to make the most of it. Unfortunately, it wasn't that simple. I also discovered that materials, i.e. the cost of sales, were running at 60% of sales. No wonder he was stressed. This left only 40% for overheads, rent, salaries, heating, lighting, marketing, and this simply wasn't enough to make any profit. When I dug a bit deeper, I discovered that not only was the pricing structured in a way that made the margins too small, but the business wasn't charging for collecting and dropping off vehicles. Some of Lee's customers lived a considerable distance from the garage, and this was costing him heavily in terms of fuel and labour. He was energised by detail in the numbers, and Lee took to what we did next like a duck to water. We implemented an accounting software solution called Xero, and I taught him how to create a financial forecast, how to input this into Xero and run reports, and crucially, how to calculate the price he needed to be charging on each job. By making sure that the cost of the parts was always 50% of sales or less, Lee ensured that there was always enough profit to pay for the running costs of the business and leave a small amount. He also created a system that calculated a fair price to charge for collection and delivery depending on the distance the customer lived from the garage. These small changes, forecasting, accounting software, and a method to ensure the right price was charged really started to change things. My concern, as it always is when I begin working with a client, was whether Lee was going to be able to make the mindset change required. The first few weeks are crucial because they are about taking some steps that undoubtedly will feel uncomfortable. Remember, Lee was of the belief that it was impossible to have customers, happy customers who were charged a fair price and make a profit. 6 months down the line, Lee had grown sales by 24%, given himself and his business partner a salary increase, and made a profit of 7% compared to breaking even the previous year. This alone would have been rewarding, but what was even more so was seeing Lee's change in demeanour and mindset. He was starting to dream of what else was possible, not just with his business, but also in other areas of his life. KPIs and critical indicators. There is a big difference between what we call key performance indicators, i.e. KPIs, and critical indicators. KPIs are what appear on the profit and loss statement. For example, the figures that represent what has been and gone. It is a bit like looking in the rear view mirror of our business. It is important to review these, of course, but there isn't anything we can do to change them. Critical indicators, however, are metrics that need to be tracked on a daily and weekly basis. Every business will have between 3 and 5 of them. Think of them like a set of traffic lights that alert you to a potential problem, giving you time to react and take action before it is too late. In the construction and trade industries, examples of these critical indicators could be number of new inquiries on a weekly basis, number of quotes submitted, number of quotes resulting in business, percentage of jobs on track to timeline, and labour hours used against the forecast. If one of these begin to go in the wrong direction and you were tracking it weekly, you would be able to react and take action in time. Profit and loss, balance sheet, and cash flow. I'm often asked by clients, so if that is how much profit I'm making, how come it's not in my bank account? The trouble is that few accountants, in my experience, take the time to explain to their clients the difference between the three key financial reports in any business. I should probably thank them, as this contributes to us being so busy. So in layman's terms, here is the difference between the three reports. A profit and loss account simply shows you how much you've invoiced, how much you've spent on the sale, for example, materials and subcontractor labour, how much you are spending on running the business, i.e. your overheads, and how much profit you have made altogether on jobs. There are some key reasons why the profit is not possibly showing in your bank account. So the first one might be cash flow. The customers may not have yet paid their invoices. Another one might be that you're financing the jobs, i.e. you're buying the materials up front and there's a big time lag before the customer pays you. Maybe you're paying for materials on a credit card and this is not being linked to your accounting software. Or possibly you're taking too much money out of the business. A balance sheet. So a balance sheet shows the business's assets, those which it owns, together with debtors, people who owe it money, and cash reserves, as well as liability/creditors to whom it owes money, for example, outstanding supplier invoices. A cash flow statement, well, this shows the expected receipts of cash based on what has been sold and when payments are expected. It will also show what is due to be leaving the business, for example, in the form of payments to suppliers. So once you're starting to track and measure the numbers, it's so important to then know how to analyse them. I was working with a local glazing company many years ago. The business owner, George, was clearly a people person. He enjoyed being out there doing the work, but also knew that for the business to grow and for him to be less stressed, he desperately needed systems and processes. I discovered that there wasn't any analysis of the figures taking place. George had Sage, another accounting software package, in place, but wasn't running any reports to analyse the figures. Hence, he wasn't identifying critical indicators, such as the amount that was owing to the business in terms of unpaid invoices. Some of them were going back several months, if not years. Shortly after we started working together, George hired an operations manager, Mark, without my help, I might add. Mark had experience in the industry and George was desperate. Panic hiring is something that I often see. By this point, we had monthly profit and loss reports running, and George and I were sitting down to review them each month. We were therefore able to spot pretty soon that material costs were rising as a percentage of sales at an alarming rate. And upon further investigation, we discovered that although Mark had experience in the glazing industry, he was making crucial mistakes left, right and centre. As I'm sure you can appreciate, if measurements are out just by 1 to 2 millimetres, the glass cannot be used, causing costly wastage to the business. Fortunately, George was able to spot this fairly soon and take action, but had he not been analysing the figures, it would have gone undetected for a lot longer. Working capital. Do you have enough working capital? This is the amount of money you have in the bank account to give you breathing space. For example, should you need to finance a job by ordering the parts before receiving the money? Generally speaking, this figure should be 3 times your overheads. So if it costs £6,000 a month to operate your business, ideally you should always have £18,000 or more in the bank. I recently met with a construction firm which specialised in building high-end market homes, all in the £2 to £5 million bracket. It amazed me how close to the wind it was operating. There were few reserves in the bank account, which meant that it would only take one customer not to pay an instalment on the project and the business would potentially go under. This is one reason why there are so many insolvencies, I think, in this sector. It's often due to lack of organisation and financial analysis, but sometimes it is due to the fact that business owners are just taking on too much risk. Managing cash flow. Do you have a process in place to manage cash flow? It doesn't matter how many sales you are making, until the money is in your bank account, you run the risk of being a busy fool. The general pattern I see is business owners rushing around, seeing customers, checking on jobs, and running off to get materials that haven't yet been ordered. They then get home in the evening and set about preparing quotes to email to customers, and this often spills over into the weekend. They are often simply too tired to get around to doing the invoices, so this takes a back seat, getting done too far down the line. Hence, it is often the business financing the job. If you need to order £2,000 worth of materials for a job, but you are not invoicing the customer until 6 weeks later, this is 6 weeks that you are carrying this cost. Cash is king. We need it in the bank account as soon as possible and want to be carrying as little risk as possible to ensure that we stay financially healthy. I'm sure the majority of insolvencies are not due to a lack of customers, but rather poor cash flow, poor profit margins, and taking on too much risk. As I will advise frequently, find someone who can manage the whole back of house operation efficiently. Don't try and do it yourself. Often it won't be your strength, and this employee will more than pay for themselves. By using accounting software such as Xero, your office assistant can create invoices quickly and send them to the customer, along with automatic reminders if the bill is not paid. So how do you know which jobs are profitable? By having accounting software in place, it is possible to set up each job with a different cost centre. Providing costs for those particular jobs is attributed to the relevant cost centre. It is then possible to report on the profitability of each job, which is a must in the construction and trade industries. But it is often one of the key processes that I find are missing. And finally, terms and conditions. Having clear terms and conditions of business in place ensures that you are less likely to have problems with non-payment of invoices further down the line. It also sets you apart from the competition that hasn't bothered and places you in the professional camp. The other important reason to have terms and conditions in place is so that if you are unfortunate enough not to have received a customer's payment after 3 reminders, you have the option to take them to a small claims court. If you don't have any terms and conditions in place, it can make it less likely that you will be successful in your claim. These are not prescriptive, but as a general guideline, it is a good idea to send an email when the invoice becomes 7, 14 and 21 days overdue, supported by a phone call to the debtor. The emails can be automated using a system such as Xero, and the phone calls outsourced to a bookkeeper or virtual assistant if you don't have an office assistant in place. I cannot stress enough that the reminders should never be sent by you for 2 reasons. Number 1, you'll instantly appear to be a one-man band and lose credibility. And number 2, it can have a negative effect on your relationship with the customer. If you have followed all your internal processes correctly, the quote was sent out with terms and conditions, the invoice was sent out on time, reminders were emailed and supported with a phone call, and your customer still has yet to pay, well, what's the best way to manage this? My recommendation would be to hand it over to a reputable debt collection agency. Yes, the debt collectors will take a percentage of the bill if they're successful in retrieving payment, but trust me, it is well worth it. They are the experts in getting customers to pay and again show that you are serious about collecting the money. They will also advise you on whether or not it is worth going to a small claims court. I really hope you've enjoyed today's podcast. Please do share on social media. And if you'd like to learn more, head over to my website, www.evolveandgrowcoaching.com, where you'll find more details and also my book, Build and Grow, which is available on Amazon. Finally, you can also support the show by writing a review and subscribing on iTunes.